You know that feeling when you're watching the news and the economy just feels like this giant, unpredictable machine? One minute, everything's booming, and the next, everyone's worried about a recession. Well, for a long time, economists thought they had the controls pretty much figured out. But then a single paper from 1961 by Milton Friedman called The Lagging Effect of Monetary Policy came along and basically threw a massive wrench into the whole machine.
So let's just start with a really simple question. Can you steer an economy the same way you steer a car? I mean, think about it. When you're driving, you see a problem up ahead, you turn the wheel, and bam, the car responds instantly. It feels like it should be the same for the people managing the economy, right?
Well, here's the thing. Friedman's big idea was that the economy isn't a car at all. It's much, much more like a giant oil tanker. See, with a car, the response is immediate, it's predictable. But with an oil tanker, you turn that huge wheel, and for what feels like an eternity, nothing happens. And then, so slowly, that massive ship finally starts to change course. The response is huge, but it's dangerously delayed. And that one analogy is the key to this whole thing. Okay, so if the people in charge are at the helm of this giant tanker, what does that actually mean for them? Let's dive into what we're going to call the central banker's dilemma. The main tool they're using, their steering wheel, is something called monetary policy. Now, that sounds complicated, but all it really is the way a central bank, like the Fed here in the US, manages the money supply. It's their brake pedal, it's their gas pedal, it's the whole control panel all rolled into one. Now, back in the day, the conventional wisdom, summed up perfectly by economists like J.M. Culbertson, was that this steering wheel worked pretty fast. The thinking was, if the economy gets too hot or starts to stall, you just make an adjustment and you'll see the main effect in about 3 to 6 months. Totally predictable. They really thought they were driving a car. But this is where Milton Friedman comes in and asks a devastatingly simple question. Is that actually true? How long does it really take for a turn of that policy wheel to move the whole economic tanker? And as it turns out, the answer changes everything. And what he found, well, it sent absolute shockwaves through economics. After poring over decades of data, Friedman's conclusion was as simple as it was explosive. The lag in monetary policy is both long and variable. This wasn't just a small correction to the old theory. It was a full-on assault on the entire idea that you could fine-tune the economy. Let's break that down. First up, the long part. Friedman found that when policymakers slammed on the brakes to cool down a booming economy, it took an average of 16 months for that action to really hit. 16 months. That's a year and a half. So much for 3 to 6 months, right? And it wasn't a fluke. It was the same story on the flip side. When they hit the gas to fight off a recession, it took an average of 12 months for the economy to hit its lowest point and finally start to turn around. We're talking about incredibly long delays here. But here's the real kicker. The fact that the lag is long isn't even the biggest problem. The true danger, the thing that makes this so hard, is that the lag is also completely unpredictable. It's variable. He found that the timing could swing wildly by about 6 or 7 months on either side of that average. So what does that actually mean? It means even if the average is, say, 16 months, the next time it could be 10 months, or it could be over 2 years. You just have no way of knowing for sure. The timing is all over the map. And look, this wasn't just some wild theory he came up with. Friedman backed this up with a mountain of evidence. He analyzed 18 different business cycles, making sure to exclude the major wars, just to prove his point. And the data was just staring him in the face, showing a remarkably consistent pattern. Over and over again, he saw it. That 16-month lead from a monetary tightening to an economic peak, and that 12-month lead from easing to a trough. The numbers just clearly showed this huge, undeniable gap between cause and effect. But he didn't just stop at the statistics. He made his case even stronger by looking at specific moments in history, showing the theory in action. He looked at different kinds of monetary systems, and he always found the same thing. Big changes in the money supply always came before the big changes in the economy. So let's get to the bottom line here. Why does any of this matter? What's the real-world consequence of this long and variable lag? Well, this is where we see the real trouble with trying to fine-tune an economy. Friedman himself put it perfectly. He said that these long and especially these variable lags mean that any action you take is probably going to be a bad fit for what the economy actually needs when the action finally kicks in. You're always fighting the last war. Let's just walk through how this can go so wrong. So first, the problem, the economy is running way too hot. Step 2, policymakers do the logical thing and hit the brakes. But remember the lag. For the next year, maybe more, nothing seems to happen. Then, during that long wait, the economy might just start to cool down all on its own. And that's when it happens. The powerful braking action they took a year ago finally slams into the economy, hitting it right as it's already slowing down. And just like that, what should have been a gentle slowdown becomes a painful recession. The policy that was supposed to help ended up making things so much worse.
Okay, so if the old way of driving the economy is so incredibly dangerous, what's the alternative? This leads us to the huge and kind of radical policy implication of Friedman's research.
If steering the economy really is like commanding a massive oil tanker with a steering system that has a long and totally unpredictable delay, and if trying to make sharp turns just risks capsizing the whole ship, then how in the world are we supposed to navigate it all? Friedman's work leaves us with a really provocative thought. Maybe, just maybe, the wisest thing to do is to stop yanking the wheel back and forth all the time.